What goes into that entrepreneurial ecosystem of yours, big, small, and new businesses and many aspects around it? We'll talk about that today on Culture Builder Live. Hey, I'm Chris Wink. I'm the CEO and co-founder of Technically, the news organization with a community of technologists and entrepreneurs. 15 years, we at Technically have covered the entrepreneurial ecosystem and the intersection of large business, small business, new business, how they institutions and the like, who and where people are doing this. That's the whole bang. One organization we have covered for more than a decade now is TEDCO, Maryland's state-backed investment firm. In 2020, they got a new CEO and executive director, Troy Lamau-Staval. Troy, thank you so much for being here. Oh, Troy, we got you muted. How do we do that? There we go. Troy, thanks for being here.
Can you hear me?
Yeah, you're coming in loud and clear now.
Cool. I got the mic
in here.
And my AirPods don't seem to want to work. You gotta love technology. It doesn't want to work when you want it to work.
So we're making it. We're doing it live. We're making it work. So Troy, you have been around in your career, entrepreneurial ecosystems in many forms. You're now leading one of the country's most interesting state-backed investment firms. TEDCO has always intrigued us how you mix real on-the-ground economic development policy, but you guys get it wrong too. We're going to talk about the challenges too. Start off. How the heck does someone in your seat, a lot of pressures, state-backed work, on-the-ground work, how do you know startup programs actually work? A lot of things start, don't last. What is your sign of success? What do you talk about and think about every day?
No, thanks for that question. And thanks for the time today. And thanks for all the years that you provided us coverage and support of what we're doing at TEDCO. Just real quick, we've been around for 25 years. We just celebrated 25 years just a few weeks ago, and you helped us celebrate that. And so thank you for that, and thank you for all those years. To answer your question, you're right. There's a lot there, and I'll try to be succinct in my answer because this is what I could talk all day on. Because it is a challenge. Because look, at the end of the day, the failure rate for startup enterprises, like 80% of most startup enterprises fail. That's the number. But not too much detail. I think in a thriving ecosystem, you have four types of companies: really big ones, kind of smaller, bigger, smaller ones, and really kind of mid-sized ones, and then these startups. And the whole goal is, I think too many people, we get caught up in thinking that everything's got to be the next Google or the next Google. That's just not the case. Most of them, if they get to be a 10, 15, 20, $30 million company, that's a success. And we should understand that that's just as much a success as one that becomes an IPO or becomes $1 billion or becomes a unicorn. And so I think part of the answer, Chris, is a redefinition of what the definition of success. That's separate from those that just fail because either the market doesn't accept them or bad management or can't raise the money and all that stuff. That's fine. Those things happen, and that's a natural order of things. But the definition of success should not be just because they did not become an IPO that they were not success. So at TEDCO, I think of two different types of companies that we invest in at a real simple level. One of those that will become that will attract institutional capital, other institutional capital, hopefully outside of Maryland, because we want people to see Maryland as a destination for strong entrepreneurial and innovation. But the other type of company, through our social impact fund, we invest in those companies that have a great idea, solves a problem in the community, but may never be a source of attractive source for outside capital. But they could come a $10 million company and may pay us back a 1 or 2x. And I will celebrate that victory, that success, as much as we get a 10, like we just got recently a 10x or 12x we just recently got in a traditional pathway. Bain Capital bought our position out in one of our recent companies that I think you put out a press release on. So thank you. And so, but I think the other thing in this, the definition of success for a state is we can't assume that everything that starts and grows in Maryland is going to stay in Maryland. That's just not a natural order of things. Now, do we need a high percentage of them too? Absolutely. I talk about this notion of stickiness, and we need to have a higher level of stickiness of those that start, are invested and grow and scale in Maryland. And we need a higher level of stickiness of that. Absolutely. But that stickiness quotient, which we can measure, will never be 100%, nor should it be 100%. Because I think it's actually valuable for us as a state to have companies that start here, scale here, get bought and go somewhere else, because they become walking billboards to other areas of the country and even the world that says, that's what they're doing in Maryland. That's what they're doing in Maryland. I need to go see what the heck they're doing in Maryland. If that kind of company, which is put it wherever you want to put it, is doing great things, that becomes a billboard for Maryland.
We, across our markets, technically have long wrestled with how folks will challenge economic development strategies generally, particularly government-backed ones. What is the highest and best use of funds? As you alluded to, companies you invest in will fail almost by definition. Just this week, we technically reported on a legal case in Philadelphia against a founder that had been backed by Pennsylvania's state-backed investment firm. There's a fraud claim, and inevitably these conversations happen of like, well, is this the best use of our government dollars, of our state-backed dollars? So I'm curious, when you get pushed, why do states care so darn much about founders, and shouldn't we be using those dollars elsewhere? Why is this the best use?
Great question. So another one I could talk all day on.
Yeah.
So states invest in the infrastructure of their state. So let's use an example of roads and bridges. So in order to, I sit here in my subdivision, you're sitting in your home. In order for your home to have been built, somebody had to build that road. Somebody had to build those utilities. And that initial cost is high risk, right? And so someone being the state was the one who put that road in, who laid those initial utility lines in, because that's infrastructure. And states and cities and counties have part of their is to put in that infrastructure to create that seed so that developers will come in, the private dollars will come in and build the homes, build the apartments, build the retail outlets that leverage that road, right? And so the risk that's involved at this very early stage where TEDCO invests is the infrastructure for the economic development. It's that road. And so you can't build a highway unless you have an on-ramp, right?
Yeah.
You can't build a highway unless you got streets that feed into the highway, right? And so this notion of economic development is that big 5-lane highway. But if you never have on-ramps to it, if you never have streets to it, how do you ever get on it? And so the states have that in my opinion, responsibility to put those on-ramps, to build those pathways to that big lane that gets them there. And the risk that's associated with that is something that the private sector just won't take on, right? They just won't take that risk on. And so states, that's a great place for the states to take that risk on. And I think I know our friends in Pennsylvania, I work with those guys, and our friends in Virginia work with those folks as well, know those folks as well. We have the responsibility, an obligation to make that happen, but to ensure that what we do attracts private sector dollars so that highway has restaurants and hotels and everything around it that leverages that initial infrastructure.
I want to touch on a couple things before I lose you in a few minutes, but I really like this infrastructure comparison. It's something that I've wrestled with for 15 years that you just connected for me. If I'm building a highway and I have a mix of subcontractors, private sector, some government workers, there's a degree of breakage. We're going to mix some of the cement wrong. We're going to, lamppost is going to get delivered broken. My job is to be as efficient as I can, and I'm always thinking about that. It just the trouble is, and where I got to think your seat gets tough is those company closures. Ain't nobody like those, and they're a lot more high profile than the lamppost, coming broken. But there's a comparison there of like we're building the infrastructure. We know because our private sector peers have the same experience. Some of these companies are going to close. There's going to be a failure rate, just is going to be. And we have reported, we understand, guess what? You end up with some unsavory characters over time. But our job is to have the right guardrails in place that more than most, better benchmark than most, we're looking at dollars in that build an infrastructure, an entrepreneurial ecosystem that benefits more Marylanders. That's kind of, is that a fair comparison? Some breakage that you have to wrestle with and you're feeling that tension?
I think two things to answer that question. Chris, I think, and they're tied. When I started this business, when I started a couple of family offices, and we were limited partners or investors in a number of the early stage, very early private equity, the venture capital firms out of Silicon Valley. I got the chance to go talk to them. These are kings and queens of out in Silicon Valley, and they told me two things. One is we have lost more than we won. But our wins were always home runs and grand slams to make up for the singles, doubles, and triples that we lost on.
Right.
Point two, which is really the important point. We always, Troy, invested in A quality people with a B quality plan and never the reverse.
Mm-hmm.
The first question I always ask our team is that person coachable? Because I don't care if you got the next idea, it's going to be the next Google. If you aren't coachable, if we can't help you, then you can go get somebody else's money. That's just the truth of it. You might become the next Elon Musk. God bless you. But there has to be a coachability. And what I'll also answer that question is, we at TechCo we use our core values of accountability, collaboration, integrity, respect, and stewardship. Those aren't just 5 words. We really bake them into how we do what we do and how we interact with the ecosystem. And so does that mean we're perfect? Absolutely not. But it means we have a guidepost that allows us to filter out those things that might have lead to the bad call. And we actually talked about it. We won't invest in certain things or invest in certain people because they've raised a red flag. And so this is much as about determining the product that they are presenting as well as the person doing the presentation.
Let's move here to the ecosystem writ large you operate in. As you've alluded to, you guys are often very early money in. You're helping to validate and offer a kind of a degree of assuredness that often has follow-on capital, which is one of your big metrics for success. We, though, as a community, so often talk about this metaphor ecosystem, and I'm obsessed with most Americans work at large companies. We care so much about small business because it's where so much of our culture comes from. It's the commercial corridor. It's that pizza shop you love, but it's also that family office. Those are things that we love for cultural reasons. But all the net new jobs come from new companies, some of whom will become really big ones. Some stay small. But there is a big, small, and new category. You also talk about institutions as kind of its own category. Just kind of curious about how you think about those interplays. You are very early on the new, some of which will become big, some of which will stay small, some of which will not last. How do you think about these pieces fitting together?
I mentioned it brief, but let me spend a little bit more time on it. So I think there are 4 types of companies in a really vibrant ecosystem. I think and these are my labels, people can have their own. My labels are at the top, you have anchor institutions. I think these are the mega institutions in a community that really drive not just the employment, but they also drive kind of civic engagement and kind of what's happening, from the
university, big membership groups, that sort of thing.
Exactly, whether it's a university or a big Fortune 500 or a big company, really big companies. I think right below that are companies who are not quite that, either because of time or money, but they're pretty big institutions. They're fairly significant institutions, and they got pretty nice employment base, but they're not as big as the big, and they're bigger than this next group, this third group. And this third group, I think, is an important group, and that's your traditional middle market companies. That's anywhere from 10 or 15, $5, $10, $15 million revenue, maybe 50 to 100. And they're strong in their communities, probably anchors in there, particularly in the smaller communities. They really are anchors. They drive a lot of I see baseball, they may drive sponsoring the little league teams and all that stuff in their communities. Below that is where we play, to your point. It's that entrepreneurial piece, the startups, and even your tech transfer university research piece. Now, that setup is important because what needs to happen in a strong ecosystem is technology and talent and treasures need to move between them. In other words, the big companies, somebody there is going to come up with some cool ideas, going to get spun out, and it becomes at the bottom of this pyramid that I just described, right? And eventually they're going to move up. But also what happens is people should be buying, and mergers and acquisitions or licenses should be happening in that ecosystem. And so as people move, technology moves, and if you will, treasure moves. I talk in alliteration. So And so that's a vibrant ecosystem. And so it was my point I was making earlier. We got to redefine success, understanding that those four levels, that not every company at that startup level is going to become an anchor institution or even the next pre-anchor institution. If they become a solid middle market, 10, $15 million company, big thumbs up. And so we've got to redefine what that success means, Chris, that it doesn't mean that everybody, nor will everybody. Not only will a lot of them fail, absolutely correct, but not all of them, nor can they all become billion-dollar enterprises. That's just not, just frankly, just not realistic. And so to me, success has to be redefined. And I'm an engineer, computer scientist by training. I believe language matters. And we need to spend more time rethinking what language means. And the last thing I'll say on this is back to my alliterations. And I'm going to talk specifically in Maryland, if I may. I talk about the four S's. I think in Maryland, we've got to scale differently. We've got to start putting a zero behind things. When we're putting 50 million to something, it needs to become 5 billion. We're putting 5 billion. We got to scale different. But one of the ways you scale is you stitch. We're a state of 6 million people, which I grew up in Houston, Texas. That's the metropolitan area of Houston, Texas. Right. And the whole physical state of Maryland can fit in a western county of Texas. Okay. So we're not that big, but we got we got some amazing assets. We have some of the best assets in this country. That's not hyperbole. That's just a fact. And so if you scale and stitch those assets in a better way, when you stitch, you scale, and when you scale, you stitch, you can do a better job of doing what you do, of storytelling in a data-informed way and telling the story. And by the way, Chris, if you storytell better with data, guess what you get access to? More resources, which allow you to do what? Scale, stitch, and storytell even better. You create a do loop. But I said there were 4 S's. So if you scale better, you stitch better, you storytell better, you get a higher level of stickiness of companies that are started, invested, and scaling. Not all of them, that will bring highlight to what we do here in Maryland on an innovation entrepreneurial landscape.
I gotta let you go here in a sec. I'm just on the way out. We have done so many experiments across the country on investing and trying to gin up entrepreneurship. And for decades, it didn't work. We saw declining rates of entrepreneurship in the United States. And then during the pandemic, it popped and entrepreneurship has surged again. As I alluded to, not everyone's growing them, but we sure are starting a lot of them. Mm-hmm. I'm curious if you think the foundation that groups like TEDCO, but many others in Maryland and around the country, if you think the foundational work we did allowed for that pop to happen during the pandemic, if it's allowing it to last, and if so, because I'm assuming you have to say yes to those, if that's the case, are you seeing those bets, those programs, the investments that you're like, this is easy money, guys, we should do these investments because we know they work and we could do more of them? So has our work done a thing over the last 20 years? And if so, what do we know are the bets that we should keep making or grow because they work? And like the specific program for me interests me. What stands out to you as it works?
So I think, to your point as we close, I think, for me, obviously, I'm going to say TEDCO works. I mean, we just did a study about a year and a half ago, said we have about $2.5 billion economic impact to the state, and we know that number's undercounted. I mean, we know there were pieces that we didn't count in that. So it's closer to over 3 billion, maybe approaching 4, over 25 years. And the way I did the math, and I report this to legislators, we had about 160 folks come through the doors of TEDCO. And so if you do the math on that, that's like a $25 million impact per employee. And last I checked, we weren't $15 million impact per employee, and we ain't paying nobody $15 million. And so, if you do it over the 25 years, it's like a couple of $1 million a year of impact. So it's real tangible impact that the TEDCO model has had for the state of Maryland. So obviously, but I think to answer your question more directly, I think what we have been more intentional about at TEDCO is that we know that we have an and function, and I call it now an and function. That we know we've got to have this we got to have financial returns, but we also have to have this economic impact to the state, and that's jobs, tax base, viability. We also know, though, the other and now is we have to reach communities, Chris, that but for have not been reached. And so what I'm very proud of, I think we just put I think there's an article that came out today about this, that Maryland's the number 2 in the country in terms of minority entrepreneurship overall, not just tech minority entrepreneurship overall. And what I'm proud of at TEDCO, and I've been here coming up on 3 years, is that we've done just shy of 100, well, over 100 deals by now. And because my dad is a little off timing wise, but about 100 deals by this point. And more than half of those deals and almost 60% of the money has gone to an enterprise started by a person of color or a woman.
Mm.
Contrast that at the national level where it's 2%.
Right.
And so the last answer to your question is you can do both. We can focus on those things that we have traditionally focused on in bio and life sciences and cyber and other areas that are started by anybody. But to be intentional about starting those enterprises that are started by someone of color and rethinking it. And so I'll close with, again, another, because now we're talking alliterations, I'm talking analogies too. So some of your audience will have to go YouTube this one. But if George Jefferson and Wheezy come back and start a cleaning business, again, if y'all don't know that, go check out YouTube. Come back and start a cleaning business. Moving on up, check it out. And they have technology that cleans clothes better, faster, cheaper, or delivers them in some Uber-like fashion. The question, Chris, is this. Is George and Wheezy tech entrepreneurs who just happen to be in the dry cleaning business, or they dry cleaning entrepreneurs using technology to fundamentally change the dry cleaning business? That's the question we are asking, because we believe any business can be a tech-enabled or tech-based business.
Mm. And that is probably a great way to go out on the conversation around entrepreneurship and ecosystems generally. Troy, thank you so much for the time. Thanks,
Chris. Appreciate you, buddy.
Troy Stovall from TEDCO, state-backed investment firm in Maryland. Thanks so much. We'll see you next time. Culture Builder Live.